Hello, my viewers. This is Joseph Julius, and on our today's topic is on investment portfolio risk. If you haven't subscribed to our channel, please go to YouTube, search for Leagile Show, and hit the subscribe button, and we'll see you there. Welcome. Introduction. Risk is just the potential for unfavorable outcome and that can actually be quantified. That means risk can be measured. So it is also a measure of uncertainty. And what is uncertainty? Uncertainty refers to the set of possibilities, positive or negative, whose measure is an assigned set of probabilities. Hello, please, if you haven't subscribed to our channel, please take a minute and subscribe. Thank you for subscribing, and we continue. Sources of risk. We have the first one called the interest rate risk. This is just the variability in a security's return resulting from changes in interest rates. So such changes generally affect inversely securities price, move inversely to interest rates. Remember, interest rates affect bonds more directly than common stock. Financial risk is associated with how a company finances its operations. So remember, the larger the proportion of assets financed by debts, the larger the variability in the return. Business risk. This is the risk associated with doing business in a particular industry or environment. It is also the risk associated with operating cash flow. Remember, if you talk about financial risk, remember the larger the proportion of assets financed by debts. Remember, as you use too much debts to operate your business, there will be higher chances of being involved with greater risk that can actually affect your business operations. So business risk is also the risk associated with operating cash flows. Exchange rate risk. This is just the variability in return on securities caused by currency fluctuations. Remember, this can also be as a result of inflation in various countries. Market risk is just the variability in return resulting from fluctuations in the overall market. Now, remember, market risk mostly affect common stock. If you haven't subscribed to our channel, please take a minute, hit the subscribe button, and we'll see you there. So moving on to the type of risk. Remember, we have two types of risk in this case, that is the systematic risk and the non-systematic risk. Remember, the systematic risk is also called the market risk. This is the risk attributable to broad macro factors affecting all securities. Remember, this one is not easily avoided. Then you have non-systematic risk, which is just risk attributable to factors unique to the securities. These ones are very specific to securities. So remember, this one can be even be minimized or be avoided by investors. Remember, risk consideration is very critical to investors. So how will you know your total risk? Total risk is given by systematic risk plus non-systematic risk, or general risk, which is still the systematic risk plus specific risk, or market risk plus issuer risk. Remember, market risk we said is the systematic risk, and issuer risk is still the specific risk or the non-systematic risk. Remember, this is just an introductory part. we'll be able to calculate some of the risk using the standard deviations and variances. So subscribe and wait for the continuation of these topics. Remember that we'll also be able to check on return and calculation of returns in investment portfolio. Thank you for watching. Like, comment, share and subscribe to our channel.